right. Welcome everybody to AIIC Group's webinar with special guest attorney Catherine Holmes. She's a specialist securities attorney. We're going to be covering a lot of topics here today. In particular, today's webinar focus is on, what investors should be looking for in EB-5 projects. What are some things, red flags perhaps to look out for? What are good things to do and look for? And of course, Kathy has, decades of experience structuring all different types of projects out there from hotels to infrastructure type projects to assisted living to condominiums, so all different types out there. And so we'll get to that in a minute here. So first off, welcome
Kathy and Aaron to today's webinar. Appreciate your joining us here today.
Thank you.
Thank you. Good to be here.
So yeah, a little bit about AIIC Group, and then we'll dig right into the questions here. So American Investment Immigration Company. We've been around for over 15 plus years, and have done over 1,600 families, over $850 million in raises, from countries all from Indian citizens, Chinese citizens, Vietnamese, Brazilians, Mexico, all over the globe itself. We've had 21 successful projects. What we pride ourselves on, and we can get into those details if anyone has any questions after. All eligible investors have been fully repaid back in all our AIIC Group projects. We act as the regional center as well as the NCE, the new commercial enterprise, in all of our projects. Of course, one of our partners, Kevin Wright, is actually flying back from China now, but he's actually responsible for 1/3 of all regional centers and the creation of all regional centers in the United States, so over 230 RCs. And if anyone has any interest in discussing any of our open projects right now, we do have I-956F approved Aspen Base Hotel project, which is in first position, and some upcoming infrastructure and HUA dual category projects, backed by government bonds and owned by the city, which we can discuss later. Just a little bit about the partners, involved in EB-5 for quite some time and working with government officials and politicians in the EB-5 space for many years, from both sides of the party, from Obama to, myself with Trump, and India side with Modi ji, and of course, Hillary Clinton with Kevin. So a little bit of background on the four partners, and then we'll give some background on Kathy, of course. Kevin, again, world famous economist, sold his company to Baker Tilly, has done EB-5 projects and business plans, economic analysis, feasibility studies for all different types of projects out there, from our own to some of the other players out there as well, that some names that I'm sure you've heard of. Aaron Goforth, one of the partners at Wright Goforth, and chairman of the Wright Johnson Group, has raised over $2 billion in commercial real estate projects, also very heavily involved in strategic business consulting and monitoring development of progress of these type of EB-5 projects. And then last but not least is Congressman Aaron Schock, who taught me everything about EB-5 many, many years ago. Initially, when we first partnered up, he was the chief sponsor of reauthorizing EB-5 law in U.S. Congress. And then today, our special guest is Kathy Holmes. She's been in the industry for 40 plus years, helping clients all over the world. A little bit about the firm. So it has extensive experience. JMBM has extensive experience in all types of EB-5 projects. So again, structuring the projects, preparing the documents for them, working on the investments and bringing in capital for them, whether they be foreign capital, both from the investor perspective or from raising EB-5 capital, a specialized securities attorney, but, projects, whether it's assisted living or commercial real estate hotels or mixed in use residential properties, mining, manufacturing projects, all different types of projects out there. And Kathy, who we're very honored to have here today, she's the chairwoman of JMBM's Investment Capital Law Group. She's also the author of the Investment Law Blog. Yeah, so we can start with some questions, and we'll go from there. So again, thank you, Kathy, for joining us here today.
Okay, great. Thank you.
Definitely. So, one of the first questions I have, Kathy, is like, when you're looking at, structuring different EB-5 type of projects out there, what are some of the investor protections to look for? What can an investor look for in a PPM and the related documents, to show it's a safe EB-5 investment?
Okay. Well, as you said in, I think it was your first slide, the investors have two primary goals. One is to get their visa. The second one is to get repaid once they get their visa or they are eligible for repayment. So, with respect to the first goal, finding a project that will get you a visa at the end of the day, you want to look for a project that either A, is already approved, already has a 956F, so that automatically tells you that the project itself has been approved by USCIS. Now it's just a question of whether or not you personally can be approved as an investor in the program. If a project does not have a 956F, you, of course, are going to talk to your own immigration attorney and make sure that the elements of the project are all consistent with the EB-5 program requirements. In addition to that, you may look for a denial refund guarantee. So if a project doesn't yet have a 956F approval, you may look for a denial guarantee being issued by someone that says that if the 956F is not approved, that the borrower or whoever the JCE is will, or that JCE's guarantor will repay the investors. So all of that has to do with whether or not the project will qualify you, the investor, for a visa. Then the second part of what you're looking for is whether or not there are elements that indicate that you have a very high probability of getting repaid your investment at the time that you're eligible for repayment. And that is where the financial elements of the project come into play when you're looking at that. So I have a list that I look for when I'm putting together offerings for NCEs of all types of projects. Every type of project, this is what I look for. Number one, it's very important, if you can, to have an experienced developer. If you are investing in a real estate project, you want to invest with someone who has experience developing other real estate projects, preferably in projects that are the same or similar to the one that you're thinking of investing in, because that tells you that that developer knows the kind of problems that may come up, and that developer has experience in handling them and in completing their projects.
So you're telling me you don't want like a hotel developer, like in a mining project, for example?
Right.
Okay.
Or someone who's never owned, if it's a hotel, someone who's never owned a hotel before or never built a hotel before. Those are all, it's possible that they could do those things. They could be successful, but by and large, you want to look for someone who already has a record of some success in their prior projects.
Fair enough.
Yeah. So, um, another thing that is very important is looking at the capitalization that the project has. So, here's something that's very important in the PPM. The PPM is going to say, here's the total cost of the project, and here are the sources of capital that are going to be provided to meet that financing requirement for the whole project. Well, what you need to look for is language that says, we already have all of the other sources of financing that we need to complete this project. That's not always true. Some projects will say, we are looking not only for EB-5, but we're also looking for other financing, which may consist of additional equity. The developer has not raised sufficient equity to fund that portion of a project, or maybe the developer does not yet have a senior loan if they need a senior loan. So they're going to tell you what sources they plan to use for the project, but you want to know beyond that, okay, tell me, what do you already have of those sources of financing? So ideally, the only thing they still need to raise is the EB-5. Again, it's not a deal killer if they don't have every single source of financing. If they're an experienced developer, they may be going out relatively early, but you can see from their track record, oh yes, they've had a lot of prior projects with a lot of senior financing. So you have a higher degree of confidence that they will be able to get that financing.
So
But
Kathy, I have a question
yeah,
on that actually. So,
yeah.
let's assume in a project, someone's in, the EB-5 investors are in first position. The securities attorneys in the project or in the PPM may say, bridge financing, perhaps, it may not be necessary and it's not expected. However, it's in the PPM that technically bridge financing, if it were to come into play, is a possibility. How do you protect so, when a project is in first position initially for the EB-5 investors and bridge financing were to come from like a bank or someone else, how do the investors know or feel comfortable that, hey, someone else doesn't come in like a bank and take over first position if additional funding is required?
Yeah, that's a tough issue because well, you're talking about two, as I see it, on the bridge financing side. If your PPM says the developer does intend to use bridge financing, but that bridge financing is intended to be replaced with EB-5 financing, then as long as the developer, excuse me, as long as the NCE raises the EB-5 financing, there's really nothing to worry about because the bridge financing is going to be gone by the time the
Got
EB-5
it.
is fully raised. The second part of what you're asking about is, well, what happens if not all of the EB-5 is raised? What happens if there's still bridge financing in place? Or what happens if another scenario could be the bridge financing is replaced, but there's still a need for other financing, and the EB-5 that was brought in is not all that they were seeking to raise, so there's still a gap in the
Yeah.
funding. What are they going to do? In most cases, there's going to have to be permission in the PPM for the JCE to go out and get some form of shortfall financing.
Mhm.
In which case, it is possible that the EB-5 financing could be subordinated to the shortfall financing. That's how I refer to it.
What
If
if the developer gives a completion guarantee, for any short runs or they put up some sort of collateral? Does that help?
It could, but it's not the same thing
Mhm.
because if the PPM says that they're intending to go out and get X amount of financing, they have a right to do that. And if it says we can get shortfall financing and we can put the EB-5 financing in a subordinated position, they can do that. They don't have to use the completion guarantee to finance the project. The completion guarantee typically will kick in if they cannot get the other sources of financing that they were hoping for, in which case the the NCE has a right to call upon the guarantors to fulfill their completion guarantee and complete the project. But it's not a completion guarantee is not a guarantee that some other financing is not going to come in if necessary and subordinate the EB-5 piece to that financing. So
Understood.
all of that should be stated in the PPM.
That's very helpful. Thank you, Kathy. I have a very specific question. If you're looking at the capital stack, you have equity, you could have a construction loan, you may have bonds, other forms of capital. Where does CPACE fall into the capital stack? Is that considered equity, or what do you think about CPACE in an EB-5 project?
So CPACE is an interesting form of debt. So it is debt. It is not equity. But the CPACE program is a program that was designed by the federal government to encourage clean energy, clean energy for new buildings primarily. So what's unique about it is that it's funded with a long-term bond, you might call it, that is payable over a period typically of about 30 years. And it's paid when property taxes are paid. And the other unique thing about it is that if there is a default in the payment of the CPACE debt service, the CPACE cannot be accelerated. So you cannot accelerate the entire amount of the CPACE loan that was obtained. You can only you can foreclose, but you can only foreclose on the amount that is then currently due. And in that respect, the CPACE is a safer form of debt because you're not having the risk that the entire debt is going to be accelerated. So the whole thing comes due. Hopefully, somebody is going to be there to pay the CPACE debt service because there's enough value in that project that they're not going to want to lose the project just to whatever current payments of debt are then owed.
Oh, that's very interesting. And then where does that actually sit in the capital stack in terms of?
I put it as part of the debt side of the capital stack.
So it sit behind a construction loan, or it would be ahead of construction?
Okay, well, technically speaking, a CPACE is senior because if there were to be a lien put on the property because the CPACE defaulted, the CPACE loan could be foreclosed. However, the senior loan or possibly the EB-5 loan or some other lender or equity provider is going to be very highly motivated not to let that happen. So they're going to front the cost of maintaining the CPACE loan in performing status so that they will not be foreclosed by the CPACE lender.
Thank you.
So that's why, in my view, it is a less risky form of debt.
Understood.
Got it. No, that makes perfect sense. And then Kathy, you were talking about the different elements. I know one thing we were going to talk about was what a capital stack looks like and developer skin in the game. Maybe you can have perhaps talk a little bit about how you would structure or how you've structured good EB-5 projects with developer equity.
Okay, sure. So the capital stack is the blocks of equity and then the blocks of debt that are used to stack up for the complete project costs. And it starts with well, you could put it up or down. In my mind, when I think of the PPM, I typically see the senior debt first. So I've got the senior loan, and then if the EB-5 is a loan, I've got the EB-5. Either the EB-5 is in the senior position, or if it's in the mezzanine position, it's right below the senior loan. And then if there's any other debt, for example, CPACE is going to be in that capital stack that we've already talked about. and then you've got the equity side. So you may see some common equity and you may see preferred equity. When it comes to the common equity, that equity is the first to lose money. So that because they're the lowest on the capital stack, first to lose money if there is a loss of anything from the capital stack. And typically, what I would like to see is that the developer itself has at least 20% of the common equity of that project, because that means if somebody's going to lose money, it's that developer. And I want to see that they have a significant amount of money in that project because I want to see that they are going to lose a significant amount if there is a loss to this project. Because if you have a developer that has 1%, 2%, some small amount of capital, they don't lose that much money if the project fails. They walk away, sure, they lose their money, but everybody else loses way more money than they do. And you don't want that because that misaligns the incentives. You want the developer to have a significant risk of loss in that
Yeah, more
project.
skin
So
in the
they're,
game, more you put
yes,
their money where their mouth is. And how does
yeah.
it differentiate between, even in this common equity versus preferred equity, when you talk about, I mean, there's different types of equity too. It could be actual cash injection by the developer, it could be land value,
Oh,
right?
that's a
Like, I
good
mean,
point.
so how do you differentiate and what do you look for in those cases?
Yes. Okay. So, it is true that well you want to look for both what cash equity do they have in the project and also what land value do they have in the project, but it's important when it comes to land value, what you want to know is how much did the developer actually pay for that piece of property. Are they giving themselves credit for the appreciated value of the property or just for the cost of the property? Um, if they've held the property for a while, it is fair to expect a developer to receive some credit for the appreciated value of the property. And if a bank were making a loan, a bank would typically give them credit for appreciated value of the property if that value is supported by an appraisal. So, yeah.
No, that was giving me my
Is
question.
it
But
common?
you need an appraisal to demonstrate that value. So, but if a developer buys the land, gets it entitled, gets it permitted, then it could be appraised at a much higher value than potentially what they purchased for.
Oh yes, yes, a perfect example where they shouldn't just be credited with the purchase price because the property now is worth more than it was on the date that they purchased it. If they have received the entitlements and done pre-development work on the project, then the appraisal should show additional value to the property itself as a result of those additions to the value.
And would a
So,
broker letter work, or do you need a formal appraisal?
a, a, I mean, a broker letter is some evidence, but appraisals are usually much better because they're a broker opinion of value is not as detailed a report as an appraisal will be. Appraisals are required to meet very high standards. They have to look at comparable properties in the area and write up a full report of the reasons why they think the value has increased. Even then, it's not saying there's no guarantee that the property is absolutely worth the amount that the appraiser said. At the end of the day, a property is worth whatever you can sell it for, but at least it is some evidence that someone has spent a significant amount of time evaluating the value, the current value of the property before giving the developer the credit for any appreciated value of that property.
Thank
Got
you.
it. Got it. We have
Yeah.
another good investor question here. Talking back about subordinating, the EB-5 capital, if another bank loan comes in, are there any protections in the PPM that can ensure that the EB-5 investment cannot be subordinated legally? Like, is there a provision in the PPM that says we cannot, do programs out there, projects out there have some sort of language that's saying, hey, we cannot take any third-party financing?
Yes. If you're, and The governing document will be the actual EB-5 loan document, but the PPM will summarize what the EB-5 loan document says. Now, the only way that you can absolutely assure that nobody can come in and take a senior position to the EB-5 loan is if the EB-5 loan itself has a first trust deed on the property. So you want to look for that. Does it say in the PPM that this EB-5 loan has a first lien deed of trust? And then the loan document typically will say no other debt can be taken that is senior to the EB-5 loan, with the caveat that I mentioned before that you will sometimes see either a bridge loan that's coming in, and that bridge loan is going to be in a senior position until it is paid off, in which case the EB-5 may initially start in a subordinated position, or two, the EB-5 loan itself is not fully funded, in which case the EB-5 loan may allow the developer to get a shortfall loan, and the developer may be allowed to offer that shortfall lender the first lien deed of trust, in which case the EB-5 loan lender agrees that it will subordinate its position. So there are circumstances in which even an EB-5 loan in a first position might be subject to a risk that it falls out of a first position.
Got it. Got it. That makes perfect sense. Thank you. And another question here from an investor. So, given your 20% rule kind of you put together or like to see, let's say, so i.e. more skin in the game by the developer, is that the case even? So let's say if there's a bank involved that has the senior first position, then it's EB-5 capital, then the developer in third position. Is less than 20% still okay? Or is generally speaking, you would like to have, 20% skin in the game by the developer?
I personally think that is a gold standard, at least 20%. And banks, frankly, if it's a new development project, a bank is going to want their own loan will only be, say, 60% loan to cost. And then they will typically allow a mezzanine loan to come in. But in general, I think it is the standard for banks to say the total loan to cost, meaning all junior loans, cannot be more than 80% of the total cost. That's not always true. I'm not, there are certain exceptions, and I'm not saying that every project that doesn't meet that standard is necessarily a bad project, but I'm saying those are things to look for. And when you see them, when you see the developer has 20%, that is good. So check that off. That's a good thing.
Otherwise, it could potentially be a red flag, not necessarily one, but it could be.
Yes.
Yeah.
Right.
And
right.
Could you kind of equate it to, I mean, just in layman's terms, when you buy a house, like, typically when you're getting a mortgage, you're typically asked for 20% down payment. I mean,
That's
is it something similar? Right? Yep.
Yes, exactly right. Yep.
Yeah. Okay. And what about, let's say, some projects don't have banks involved, right? Let's say it's just EB-5 capital as first position, and then you got the developer. In those type of projects, there's no role of the bank or third-party capital that's doing underwriting and due diligence type of consideration, except for the NCE and perhaps, obviously the developer in there. What sort of measures or what sort of things, because there are many good projects out there like that. How do you do that type of due diligence, or what type of due diligence is good for an investor to look for?
Well, where if the EB-5 lender is itself in a senior position, then you want that EB-5 lender to undertake the same forms of underwriting that a bank would undertake. So it starts with getting background checks of the developer and all the people involved in the project. Another thing you might look for is the construction contract. Is it a guaranteed maximum construction contract? Is the contractor bonded, meaning that the contractor has a backup if somehow the contractor is not able to pay the cost of his of subcontractors, there's a bonding company in place that's going to pay those costs. You would also ask for all the organizational documents, and you would want the financial statements, certainly of all the guarantors, but also of the borrower and the direct owners of the borrower. And if they're saying they're going to be putting in additional capital in the future, you want to see that they have the financial ability to put in that capital in the future, as well as the ability if, for any guarantor to pay the full amount of the guarantee. For example, in a bank guarantee, if you're guaranteeing, let's say, $100 million loan, the guarantee is going to say the guarantors are required to maintain a minimum net worth of not less than $100 million at all
Right.
times. And
Right.
if they don't, that's an event of default, and the lender can foreclose if they want to do. All of these things are exactly what a senior lender bank would require.
Right.
So the EB-5 lender should be doing the same thing.
Yeah. So
Kathy, I
you're
have a
saying that if it's like a 50 or $100 million project, the developer should not be only worth maybe like 10 or $20 million as its total net worth.
Right, right, right.
Right.
Kathy, do you look at all senior lenders or construction loan lenders the same? So like a pension fund, local bank, do you grade them differently in terms of who the actual lender is?
Mm, if it's an FDIC insured bank, then I feel pretty confident that the bank is going to make the full amount of the loan. Um, in the case of an insurance company, I feel the same. That's an institutional lender. But if it's some private equity or private investment fund loan, then things start to be a little shakier because who knows, are they, and especially if it's a committed loan but not fully funded loan. Will they make the full funding commitment payments that they say they will? And how will they service the loan? And what happens if there is a default? Are they just going to come in immediately and try to foreclose? Because that's what they've wanted to do all along anyway, versus a bank, typically they're not in the business of foreclosing on property. So I look at different lenders in that way differently, whether or not they're an institute bank or a private lender.
Got it. Got it.
Thank you.
Thank you. Another question I have is, a lot of regional centers or NCs or, essentially EB-5 projects talk about repaying investors' capital by, essentially three different means. One is selling of the asset itself, if you're selling condos, let's say, or, to be able to repay back, or, based upon the net operating income of the entity or business or venture that's being created. Or third, and probably the most common, I would say, is refinancing of the project itself. What are some things that investors, I'm a software engineer. I'm not a banker. I'm not a, underwriter at a bank. What are some of the things that I could look for or calculate to see how realistic this refinance structure is coming into play in this project? Like how realistic are these numbers? Are there any, like debt to service coverage ratios or loan to value? Like, maybe you can put some insight on that.
Yes, the expectation of being repaid with refinancing is all based on what the projected income and value of the property will be at the end of typically a 5-year term loan. Because that's usually when senior loans are repaid. Or if it's a construction loan, sometimes it's 3 years, such as for a condo. So in the case of a condo, your condominium sales, what you're looking for is the projected sales price of the condominium. So you want to see, well, how did they determine what the projected sales price is going to be? Hopefully, it's based upon other comparable condo properties that have sold in the same geographic area in the past. So you can see that, okay, if there's a reasonable basis for the per square foot estimated sale price of the condos, then you can look and see, okay, if they are able to achieve that price, then they will be able, just through sales proceeds of the condominiums, to repay the EB-5 loan. When it comes to refinancing of an operating business, which might be a hotel or multifamily rental property, or even a manufacturing plant, or assisted living, same is true. It's all based upon operating revenues. So you have to look at what are the anticipated operating revenues that this business will have at the end of its what's called the stabilization period. So for a hotel, it's typically 3 years after the hotel is opened. And the same would be true for like an assisted living facility. So it has to get the occupancy built up first of all, and then it tends to stabilize. Apartments also go through a somewhat of a stabilization period. If they're in a high demand area, they should be able to lease up pretty quickly. But this is the same thing that a lender would look at as well. What are the projected revenues, and how does that translate into the value of the property as an operating business? And then if that property, say, apply a cap rate to the operating revenues of the property and say, okay, we estimate for these operating revenues a cap rate of 2 or 3, whatever it is, that this is what the value is going to be at the end of the 5-year term. And if that valuation is high enough to support a refinancing that's going to be able to repay the entire debt portion of the capital stack, then it looks to the lender as if there will be a source of repayment based upon refinancing through a new loan.
Got it. Makes sense. And what sort of value would you put on, RCs or NCEs getting third-party evaluators like a Jones Lang LaSalle on like doing like an economic analysis or feasibility report on EB-5 projects?
Well, I do think there's value. I think other developers get that sort of valuation for themselves to determine whether or not they think it's worth their own while to build a project, to see that there's enough potential profit in it for them. Also, hotel licensors and management companies like Marriott or Hyatt or Hilton, they all do the same thing. So even though they're not 100% always accurate, it's still a good idea to have some third party look at what the projections are based, again, upon they're going to look at all the comps, the occupancy rates, the rental rates, and apply a factor, inflation factor to it to calculate what they believe will be the projected value within the time period that will be required to get the refinancing. So yes, I do think there is value. And I think it's not just for EP5 lenders, it's for other types of lenders and investors as well.
Sure. Oh, very good. Any other questions by some investors on the channel here? Feel free to put it in the question and answer box. I forgot to mention that at the beginning. Sorry about that. I've been doing most of the questions here, so feel free to feel free to ask any questions away.
Kathy, what do you think about like private public partnerships? So if there's bonds and other public funding in a project, is there any special considerations when you see that in the capital stack?
Well, I think of that as a very good thing. That if I see public financing, that tells me that the local government considers this to be a very valuable project, so much so that they're willing to go out and get bond financing for it. So I would certainly put that in the positive column for a project.
Is that like more secure, you think, I mean, you're saying a positive column when it's like city backed or, you got a project that's repaying back by bonds or, a loan by the city itself, like that's, or owned by the city, you're saying that's a positive thing?
Yeah, yeah, I think it's a positive because I don't think the city would invest in a project with a private developer unless they felt like there would be a good return to the city for doing that.
Got it. Got it.
Yeah, so
That's good to know.
yeah,
Hmm.
yeah.
Um,
Another thing, if you guys, I want, we haven't touched on the different types of guarantees that people
yes.
might see in a project. Although we did talk about a completion guarantee, and as I
Mhm.
mentioned, that's just a guarantee that says if there's no other source of financing that we can use, that the completion guarantor will guarantee to put in the money required to complete the project. That's a good thing. Banks require completion guarantees too. So if the EB-5 lender has one, that's a very positive thing. But it doesn't mean that the loan is going to be repaid. Other types of guarantees, we talked about the EB-5 denial guarantee.
Mhm.
And that's a positive, but you have to look at what the terms and conditions of repayment are, because the conditions can vary for when the repayment is required and what circumstances repayment might not be made under certain conditions, as well as the another type of guarantee. You can have a full repayment guarantee. So an NCE could receive a full repayment guarantee from a guarantor, meaning if the borrower doesn't repay, the guarantor promises to fully repay that loan. That is permissible under USCIS standards. Just to make a distinction, USCIS does not permit a guarantee of individual EB-5 investments. That we know. But they will permit a full repayment guarantee by some guarantor that the NC's loan will be repaid. But you don't see it too frequently. Most developers do not want to give that. I'm not saying you're going to find it in every project or even most projects. Actually, you will not. What you will often see is what they call a limited guarantee, or sometimes a non-recourse carve-out guarantee. There's different names for these types of guarantees. What that is what we colloquially refer to as a bad boy guarantee. It says if the developer does certain bad things, like declaring a bankruptcy or stealing money or committing some other form of fraud, then the guarantor rather will repay the loan. But note the difference. It's not a full repayment guarantee. It's only repayment if certain bad acts occur. And you have to know what the bad acts are in order to see how 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 much value to put on that guarantee.
Got it. Makes sense. Another question by an investor. In your experience, Kathy, are there general themes or types of projects that have generated better results than others, such as, looking at luxury hotels or residential property versus like aggregate distribution facilities? Like, is there
Well,
a safer bet, maybe?
yeah, a lot of the projects uh, before 2020 were hotels. Um, and people really liked hotels because everybody knew what a hotel was, and it was easy to if it had a brand, if it was a Hyatt or a Hilton or something, people thought, well, it must be good or the brand wouldn't be interested in building that hotel. It's not just the developer, but the problem that was really unexpected, COVID just devastated so many hotels and just threw all of the projections off for a lot of hotels around the country. So hotels did not perform as we expected they were going to perform. And following COVID, not just COVID, we had the really rapid increase in interest rates that occurs starting in 2022, and
Right.
that too was just completely wiped out the ability of a lot of the hotel owners to get the refinancing that we were counting on to get repaid. So Although there have been a lot of hotels in the past, there's still, still plenty of hotels being developed. I think, we've seen more other types of properties being built, multifamily, condo development, as well as more manufacturing too, because those types of projects are not as subject to the kinds of risks that we encountered with hotels. So, and I also think we're seeing more developers actually developing those types of projects. You're not seeing that many developers develop new hotels. They might be renovating hotels, but there were, and hotels, by the way, have their own cycles where they go through periods where there's a lot of hotels being built, and then they slow down and wait for the hotels to get a little older, and then we start the cycle again. So right now we're in kind of the down cycle of hotels. So you're not seeing as many.
Got it. Got it.
Yeah.
Okay. Another investor question. How do you evaluate membership interest collateral for a mezzanine EB-5 loan?
Well, it is collateral. So it's the problem that you have is that when you're a mezzanine lender, that means that there's a senior lender ahead of the mezzanine lender, meaning that if there is to be an event of default, the senior lender gets to foreclose. And the EB-5 mezzanine lender does not have a right to stop the senior lender from foreclosing. The problem is, if a senior lender does foreclose, they have a right to do what's called a credit bid, meaning they don't have to put in cash. They just have to say, I'm bidding the amount of my loan. Anybody else who wants to buy the loan has to pay cash or buy the hotel or buy whatever the property is, doesn't matter the type. They have to put in cash. It's very infrequent that if a property is really in trouble, there's going to be any other bidders. Typically, the senior lender is going to come in, take over the property, and now the mezzanine loan is not worth anything anymore. It's only if there's another third-party bidder who bids more than the value of the senior loan that the mezzanine loan would get any proceeds. So, that is a risk. I mean, it is collateral. I'm not saying it's, and that's why you want the developer, by the way, to have a lot of equity in, because that incentivizes the developer to repay the mezzanine loan in addition to the senior loan. You're hoping that the developer is not going to allow that hotel to fall into foreclosure, because if they do, that developer is going to lose a lot of money. And if they are a developer that has a good capitalization, they don't want that to happen, other than in the most dire of circumstances. So your mezzanine loan collateral will be worth something if you have a developer who's put in enough equity that's worth their while not to allow that senior lender to foreclose.
All the more reason to have more developer equity, like you were saying before. Because they're
Yes.
going to avoid that foreclosure type of situation because nobody wants to lose out on that capital, the developers.
Right.
Makes sense.
Yeah.
There is a question here. I was going to type out the answer, but I accidentally clicked to do it live. So I'll ask you that question then, Kathy. So what exactly does a completion guarantee mean? So, like when a project says there's any cost overruns and the developer says that they'll take on via the completion guarantee. Can you elaborate on that a little bit, please?
Yes. So a completion guarantee, first of all, is a third party, usually the owner or the parent company of the developer, because the developer, generally speaking, only owns one property, which is the property being developed. It doesn't have any other assets. So you want some third party, like the parent company, or maybe there's two
Could
companies,
be a
but
family
someone,
office, the individual, like who owns the
the
development company,
individual,
typically. Yeah.
that's right. If they come in and give a completion guarantee, what it will say in general is that if the borrower does not complete the hotel on time and in accordance with the plans and specifications, that the guarantor agrees that the guarantor will come in and pay the costs of completing the project. Which is very important for EB-5 because we want that project to be completed in order to get the number of jobs that are necessary to support the visas. And we also want the project to be completed so that it can be sold and hopefully repay the EB-5 loan. But what you have to look for there too is completion guarantees are fully negotiable. That not every completion guarantee says the same thing. So some completion guarantees are really ironclad, and it says it doesn't matter if there's cost overruns, it doesn't matter what it is, you guarantor have to pay it. And other guarantees are more, they'll be a little bit, they might be more limited in certain ways where they'll say, well, we don't have to pay for any changes in plans and specs that come along afterwards. Things like that, that the developer or the guarantor rather is trying to protect themselves from costs going higher than they're anticipating.
Right. So you want generally to look for more of a blanket guarantee or
Yeah.
guarantee by
Yes.
the guarantor and put
Right.
up some sort of cash collateral, I'm assuming, or at least put aside, like you were saying, to prove that they can, any cost overruns truly pay for those themselves, right?
Right. Well, yeah, what you typically get, and they don't have to put up money normally in a guarantee situation, but you do have them they have a covenant that says they
Mhm.
will retain net worth at least equal to either the amount of the debt, sometimes 120% of the amount of the debt. So that's a variable. And also there's typically a liquidity covenant as well that says that they have to maintain some amount as assets that can be readily liquidated and used to pay the cost. Typically, that's much lower than the net worth. That might
Got
be
it.
10%, 10% of the required net worth.
Got it. Got it. So, like, I mean, typically in AIIC projects, what we do is we require, when we try and structure it, the guarantor to put up, or showcase at least 10x the
Yeah.
value of the project itself and of the loan, let's say the EB-5 capital. Is
Yes.
there a certain minimum number that you would, I mean, I know you said 100% or 200%. I mean, we may go a little extreme at AIIC with 10x the value, but what's a good for investors to be minimum, for their protection?
Well, I think you would normally see it's either 100% of the cost of the project or maybe 120%. Usually not 10. Well, certainly for a huge project, it's unlikely that it would be a full 10x times
Yeah.
the full cost, 100% of the cost of the project.
Yeah. So
Yeah, yeah.
10x is pretty good then.
Oh, yeah, very good. Yes, yes,
Very good.
yeah.
Let's see here. Are there any minimum quality of construction guarantees provided, as in protection from shoddy construction leading to low sales?
Okay. Um, you in some EB-5 loan agreements, they provide for a construction monitor who comes in usually once a month and looks at the construction to make sure that it was done in accordance with the plans and specifications and the permits, etc. And that's what you're typically looking towards, is that you're getting an expert construction monitor, to keep looking at the project while it is being built. Because after it's built, if something bad happens, you're not going to know about it, and unless there's some sort of damage to the property, and oftentimes that doesn't occur for quite a few years later. With condos, some states actually do have like developers are subject to being sued for 10 years in California for building condos. So if you can, you'd like the developer to have some kind of insurance to cover the cost of those types of claims. Or sometimes they put up a reserve to cover those claims in the future. So there's different methods of dealing with those risks. But they are very much important risks to consider.
Makes sense. Makes sense.
Yeah.
Well, I think we're nearing our hour here, so would like to just point out a couple things. First off, again, Kathy, for joining us here today. We really appreciate your time and your valuable input. Is there any last minute kind of things you'd like to say to investors out there, just with respect to, what to look for, or do you help investors, from your law firm, consult on projects with them just to help them, or, what sort of services do you provide?
Typically, I represent either NCEs or JCEs. I don't typically represent investors. Also, sometimes I would represent regional centers who
Mhm.
are evaluating projects, maybe not as an NCE, but just as a regional center sponsor. Um, Hopefully, the investor's immigration attorney can help out with evaluating the financial characteristics as well as the immigration characteristics of the investment, because I do think it is important for the investor to have their own counsel looking at the document and knowing what to look for.
Mhm. Actually, that raises a good question that you kind of brought up. I mean, you mentioned NCEs, RCs, you know, um, sometimes investors out there, what I've seen can kind of get confused, and they're always focused on the RC, right? The regional center itself.
Mhm.
Maybe you can kind of talk a little bit about the impact, or, what role does the NCE actually play? Because my understanding is that they're the ones that hold the fiduciary responsibility. They're the ones who are actually loaning the money. They're collecting the money from the EB-5 investors and deploying that to the JC. So maybe you can talk a little bit about the roles and responsibilities of an RC versus an NCE and how you've structured those kind of things in the past.
Okay, sure. You're right. The NCE is the entity that is pooling the EB-5 investor capital to make the investment in the JCE. So the NCE manager is the party who controls that loan and controls the negotiation of the terms of the loan with the JCE, as well as the disbursement of the loan to the JCE and the servicing and possibly even enforcement of the loan against the JCE if that is necessary. The regional center, on the other hand, is not necessarily the same as the NCE. In some cases, the regional center owns the NCE manager. That
Hmm.
is one model of a regional center. So since they're owned they have common management, so
Yeah.
they are in fact the same. In other situations, the regional center has no relationship other than a contractual one with the NCE. The regional center says, we will do the EB-5 compliance work, but we are not responsible for the underwriting of the offering or for the loan negotiations or servicing or any communications with the JCE. All of that is handled by the separate NCE manager. So when when I think about regional centers, I think, okay, they can play an important role, but it's way more important to see who's the NCE manager of this offering,
Hmm.
because they're the ones who are truly in control. And I will say there are some regional centers, even though they are not affiliated with the NCE manager, who do take their duties quite seriously and they do review the offering documents and they do give comments. And if they feel that an offering is too risky, then sometimes they'll say, we won't sponsor this offering. We don't want to get sued. So
Right.
they're,
Because the regional center will hold some liability, but if, all hell breaks loose or some type of bad situation
yeah,
comes to, into fruition, then fundamentally the EB-5 investor is dependent on the NCE and the NCE manager
yes,
to alleviate those type of issues,
yep,
correct? So it's really
that's right.
important to understand the NCE's track record and NCE's history in that space more so. But I mean, the RC is very important, don't get me wrong, but just the distinction between the two.
The distinction. And with the other model that just to know about, there are some cases in which the one party controls all three, regional center plus NCE plus JCE, all three. And some of those projects can be good, but the problem is the conflicts of interest are so obvious. If the loan ran into a problem, well, it's the same party who owns everybody in the NCE, the JCE, the regional center. There is no third party.
I mean, that could
there.
be a conflict of interest, wouldn't you say? If
A
they're
very
the
high
JCE and
conflict.
then NCE, and then if bad situation takes place,
Right.
then that's definitely more risky for an investor, I would think.
It's a much more risky situation. That's right.
Yeah, yeah, no, that makes sense. Well,
Yeah.
thank you very much. Again, we're past the hour here, so I'll
Okay.
just kind of end with, if anyone has any further questions, feel free. My name and contact is up here as well as Kathy's. I can always relay some messages as well. If you're interested in any I-956F approved projects, rural category, or city-backed or city-owned projects, we do have an infrastructure and HUA project as well. So feel free to message me on WhatsApp or email, and then if there's any securities related questions, I can get you those answers as well through Kathy. So again, thank you very much, Kathy, for joining us
Yeah.
here today.
Thank
And
you.
I
Okay.
think we'll sign off.
Right.
Very good. All
Thank
righty.
you.
Bye.
Bye-bye. Take care.